All right, so welcome to Learning Objective 2. So Learning Objective 2 introduces you to what they call the three principal types of activities that businesses are into, okay, financially speaking. One of those activities we're going to look at first is something called financing activities. Now, these are things that you personally are actually familiar with, whether you knew it or not. So, for example, where you might want to purchase a car. One of the questions the dealer might ask you is, how will you be financing this purchase? So financing means where you're getting the money to buy the car. Same thing when you went to college. Or one of the things that they'll ask you after you sign up for everything is, how are you going to be financing your college expenditures? And the financing really is where you're getting the money to pay for things. So financing activities for businesses is where they get the money to buy things that they need to run. So those are financing activities. You'll see those in more detail in a moment. Another type of activity that they talk about next is something called an investing activity. Now, you need to look at it from a business perspective. A lot of people look at it things from a personal perspective. So from a personal perspective, you look at investing activities. Oh, I'm going to be, buying stocks, bonds, mutual funds, and so forth. Well, those are investing activities, yes. But businesses need to buy things that help them sell what they're in business for. So it makes no sense for Walmart, for example, to buy stocks, bonds, and mutual funds because that's not going to help them sell more goods. They're in business to sell goods. So their investing activities would be building newer stores or bigger stores, expanding their stores, putting shelving in place that would allow more product to be there so they can sell more product, right? Making sure they had good distribution centers and trucking so they can continually stock their stores for inventory so they can keep selling more and more stuff. These are the types of investing activities that businesses see. And overwhelmingly, they're revolving around groups of purchases that we call assets that you're going to read a little bit about today. And the last type of activity that we're going to be looking at is something called an operating activity. So an operating activity, in short, happens when the business is operating. Operating means the business is open and things are happening. And so I'll go back to Walmart for a moment. They might open up at some, very early hours, 6 o'clock in the morning, perhaps, and they might not close until 10 or 11 p.m. Well, those are the operating hours of that business. And so there's a lot of activities that happen during those operating hours. And so those would be operating activities. And so that's basically what operating activities are. Some businesses have very set hours, right? They're open at a certain part in the morning, they close a certain time in the evening. Some businesses are open 24/7, and so their operating activities happen 24 hours a day, 7 days a week. And so, but operating activities are activities that happen when the business is open and operating. That's how you need to look at that word. Okay. And so, of course, we're going to be learning a bit more about how we keep track of all that stuff as we get deeper into this course. All right, so let's go back to our first set of activities, which we call financing activities. And remember, financing is about where you're getting the money to buy stuff. So think about when you purchase that car, where you're getting the money to buy. So usually people get money in a couple of ways. They either have the money themselves to buy something, or they need a loan. They need to borrow money in order to buy something, or a combination of both. They might have a little bit of money themselves and they need to borrow the rest. So these are all finance activities. From a business perspective, when you borrow money, that's what a liability is, okay? Liabilities are basically any amount that's owed to another entity from that business. And oftentimes they are called debts, but sometimes they can be a little bit more than that. And so Anytime you borrow money to buy something, that's a financing activity. So for businesses, they'll borrow money to build buildings. They will borrow money to buy trucks and so forth. Um, and so that basically is what a financing activity is for borrowing money, liabilities. Some of the more common ones that you'll see for a company borrowing money is something they call note payable. So the word note in accounting means a loan. Most notes are short term, which means they are usually less than 1 year of a loan. Some notes can be a little bit more than that, can be a little over a year, maybe 2 years. But notes tend to be short-term debt that needs to be paid back in the short term. Companies also go and borrow money for the long term. And those are what bonds are. Bonds are loans from investors. A lot of people know about the stock market because we talk about the stock market in this country every day, practically. But not that many people understand that the bond market is equally important. Um, the bond market is where investors go to lend money. They lend money to corporations. They certainly lend money to government. But this is the importance of the bond market. Investors go to lend money. So these are common types of liabilities that a company would have. They would have a notes payable, which is a short-term loan that they need to pay back. They might have loans from investors, and those are called bonds payable. So these are called, when you see this notes payable, bonds payable, these are actual names of accounts. And in accounting, remember the root word of accounting is account. And so you need to understand that it's very, very important that you learn about these particular accounts because they mean something very specific. Okay. So one way to finance is to borrow money. Another way to finance, of course, as I told you earlier, is to have the money yourself. So when you went to buy a car, you had a down payment and you borrowed the money. And you borrowed the rest. That down payment is your equity in the car. It's the part of the car you actually own outright. When you borrowed money to buy the car, the lender basically owns that part until you pay it back. Then you own it. So businesses work the same way. But the equity in a business and again, we're looking at things from a corporate perspective in this class, is shares of ownership, and we call that common stock. Common stock and shares common shares mean the same thing. Stock and shares mean the same thing. They are shares of ownership in a corporation. Okay, there's nothing other than that. That's all they mean. Okay. And so basically speaking, a company will raise money. How businesses start, whether they're very small or medium size or getting larger, is they will sell ownership of the company in exchange for the investors putting cash in the business. They need the cash to buy assets to grow. And so what they give people are shares of ownership in a corporation, which what we call common stock. So stock is also considered equity. Equity is about ownership. Whenever you see the word equity, it's really about ownership. Okay. So in this case, common stock is what the stockholders own in a company. Okay, that's their share of ownership in the corporation. Again, the purpose of putting money in the corporation is so the corporation can buy things they need to buy to sell whatever they're selling, right? Like I said, for Walmart, building more stores, improving the shelving, more trucking, other types of things, anything it takes to sell more goods, because Walmart sells goods for a living. That's their whole purpose of existence, is to sell goods. So if I'm going to be an owner in that business, I want them to sell more and more and more goods, because that's where the profits are for me. And so that's what my common stock, my equity is going to be used for. Sometimes when a company makes a profit, they will share a portion of that profit with the owners, and you're going to find out that term is called a dividend. So a dividend is when a company that makes a profit shares a portion of that profit with the owners. It's usually in cash, and so it's usually the form of a cash dividend. So dividends basically are payments to the owners when the company makes money. Mhm. So those are your finance activities and some terms to know. Liabilities, very important term. Stockholders' equity, very important term. Notes payable and bonds payable are types of liabilities. Common stock is the equity in a corporation. Okay, that's what the owner's equity is in a corporation, shares of ownership. All right, let's move on to investing activities. And again, take it out of the realm of personal and look at it from a corporate perspective. We oftentimes look at things from a personal perspective, and we need to shift our hats to a business and corporate perspective. An investing activity means that I am going to purchase resources that are going to help me sell more stuff. Okay. So, like I said, Walmart's total business model is selling goods. That's really all they do. That's all they have to offer you. When you walk into the store, there's a ton of goods on the shelves, and they want to sell them. That's it. That's their entire purpose. So you need to look at it. An investing activity is, okay, so what can I do to sell more goods? Normally, this means that I am going to purchase resources that help me sell more stuff. So maybe a bigger store, and I can put more goods in it. Again, making sure I have good distribution, so I have plenty of product in stock. So as customers walk in, there's plenty of product on the floor for them to purchase. Things along that help me sell more stuff. Better shelving, so I can fit more stuff there, so I can sell more stuff. So these types of resources in a business are called assets. We're going to be talking a little bit about that. But the resources that a company owns is called an asset. And these are very, very important resources that a company uses mostly to sell whatever they're selling. Okay. So an investing activity for a company is purchasing perhaps, click something, purchasing, more assets such as computer equipment, such as delivery trucks, better furniture and fixtures, more buildings, or expanding, renovating those buildings. So again, assets are critically important. This is a very important term in accounting that you need to know. So assets are resources that are owned by the business. The purpose of those resources is to help the business sell whatever they're selling. Okay. It is true that corporations can purchase stock in other companies. Yes, they can. It doesn't really help Walmart sell more goods and goods by saying they own stock in another company, because that's not really generating any sales for them. But they can do it. They can own it, and certainly they can have those types of investments as well. So yes, investing is an investing activity, but it's not the most important. The most important is when a company buys more assets. And lastly, what I was telling you earlier is an operating activity is anything that's happening when the company is operating, which means it's open for business. And whether those operating hours are, 7 in the morning until 10 at night, or 24/7. When the company is open for business, these are considered operating activities. Okay. And so what's the most important operating activity for a company? Well, it's to sell its products or services. Okay. The reason a company exists is to sell something. Companies can either sell products, which are called goods, or they can sell services, which is they can perform work for you, whether that's cutting your hair, doing your taxes, or other types of things like that. Those are the reasons companies exist. They need to sell something. Matter of fact, well, it's funny, a lot of students will tell me they want to set up a business. And I think it's very, very good. But the most important thing you have to ask yourself is, okay, is what are you going to sell? Because that's the whole reason to exist. Okay. The same is also true, by the way, on the nonprofit sector. We don't have to look at it strictly from a profit business perspective. We can look at a nonprofit. So the college is a nonprofit. Most colleges are nonprofit. They have to sell something. Right? We're selling courses and certificates and degrees and things like that. So even when you are a nonprofit organization, you have to sell something. You have to have revenue. So this term is very important to know. Revenue is amount, anything that you earn from selling either a product or a service. Okay. So again, this is accounting. There's a lot of accounts to understand. So one of those accounts is something called sales revenue. Sales revenue is a revenue account from selling products. So when you sell a product, a physical good, we call that sales revenue. What if you went to the doctor or a lawyer and they provided you advice on your health or your legal issues? Well, that's service revenue, because the way they earned money from you is to provide a service for you. So service revenue is really about earning money by providing a service. And most of us provide services, or we work for businesses that provide services. Of course, when you make loans, like a bank or other type of lender, um, your goal is to make loans and make that money back with interest. So the interest that you actually earn on those loans for a bank, for example, is their revenue. That's what they sell loans and they make money on those. Interest on the loans is the revenue that they have. So that's going to be their interest revenue. So revenue, critical account. Everything in a company starts with revenue. Everything, whether it's actually for profit or nonprofit, everything starts with revenue. No revenue, no organization, whatever. Okay. So revenue is critically important. Everything starts with revenue. If a company is like a Walmart, they sell goods, they're going to need to purchase inventory. Inventory, when you walk into a store, whether you're in a mall or whether you're at a basic Walmart, you see all those goods on the shelves of the store and on hangers and so forth and so on. Well, the company actually had to buy that first, and then they resell it to you. So when they buy it and put it in their store, that's what inventory is. Okay. So inventory is about those goods that the company has purchased that's available for sale to the customer. Okay. So that's another important account. Here's another account that happens, again, only when the company is operating. They might sell, particularly this is true for business to business. When one business does buy something from another business, they often will have options. When you and I walk into a business, we got to pay cash. Even when we use a credit card, that's actually a cash sale to the vendor, to the company, because they're getting cash. You're getting a bill from your bank, but they're getting the cash. But businesses can do business and sometimes not pay cash. Instead, they'll get an invoice. And that invoice means, okay, I'm going to sell you whatever I'm selling you, and you just pay me later. Later is usually within 30 days. So if I actually sell something to a customer and I'm waiting to receive the money from that sale, that's something called an accounts receivable, because I'm waiting to receive money on that account. That account represents a sale I already made to another business customer. Again, this is not happening for you and me. This is happening business to business. Certainly, companies have to keep track of everything that they use money, how they use money to sell their goods or services. So Walmart has to keep track of all of their costs. Okay, every business has to keep track of all of their costs. When that inventory, which Walmart and other companies have in their store, once they sell that inventory to the customer, that becomes an expense, something called cost of goods sold. That's a type of expense account. Okay, they probably have to pay rent. There's a rent expense. They probably have to pay their sales people. That might be a selling expense. They might have to pay for advertising and marketing. They certainly have to pay for everything else. So whatever they had to pay in order to sell their goods and services are going to be expenses. And you're going to be learning about a lot of specific expense accounts. You've already been introduced to liabilities. When companies raise money, that's certainly by borrowing it, that's a liability. But when they actually have expenses that they need to pay themselves, that can create liabilities for the company. So when the company owes money to another company because they bought something and promised to pay later, well, that's what an accounts payable is. And a payable is a liability because I have to pay that account. Sometimes I have interest on a loan I have to pay. I haven't paid it yet, interest payable. Wages that employees have earned, but payday is not here yet. So that's going to be a wages payable. I owe that to the employees, but I haven't paid it yet. So it's a liability for me. So all of these are very specific liability accounts that you are just getting introduced to, but you'll be seeing them over and over and over again, because in accounting, we talk about accounts and their effect on businesses. They're all extremely important, extremely important. When a company compares its revenues, how much it's sold, whether it's goods or services, to its expenses, what they want is to make a profit. So the specific term we use is net income. Net income basically is a profit. And that means that our sales revenue is greater than our expenses of selling that stuff. So when that happens, that's net income. However, sometimes we're not, just like what's happening in the pandemic, a lot of businesses have seen their revenue gone way down because customers are not going out, eating and so forth and so on. Well, those companies still have expenses. They still have to pay rent. They still have to pay utilities. They still have basic expenses they have to pay. But what happens when they're not selling as much? Well, sometimes their expenses are bigger than the revenue. Right? They're not selling all that much, but they still got to pay all that other stuff. That then puts them in a situation where they'll have a net loss for a period of time. And so that's something you're going to be learning in more detail in the next learning objective. But you just get introduced to a whole bunch of accounts. And so it's good to sort of review what these are. So the do it exercise for this part 2 really talks about if you read about what something is, how would you classify it? Remember, an asset is a resource that's owned by the business. It's also an investing activity. Liabilities are debts that are owed by the business, right? They owe this to others. They got a loan, they got to pay it back. Common stock is really about shares of ownership in a company. Revenue is when they sell a good or a service, the amount they earn from selling that is revenue. And expenses are the costs that are involved in the business to sell what they sell. So when you look at the cost of rent, that's actually, it's going to be an expense. It's something that's specifically called rent expense. Rent is due every month. It's just like if you and I have rented an apartment, we have to pay our rent every month. Well, that's how leases work for businesses as well. They'll sign a lease to rent a space, whether it's an office or a large building, and they will have this regular monthly rent that they have to pay, and that's considered an expense. It's considered an expense because they need to pay the rent to keep the store open, and if that store is how they sell their goods or services. So it's directly related to generating the revenue. If they bought a truck, the actual truck itself is a resource for the business. And so it would be considered an asset. Okay, a truck is an asset because it's a resource that's owned by the business. That truck might be used to deliver a bunch of things and help the company expand where it can sell its stuff. The third thing here we looked at already, called a notes payable. The word note in accounting means loan. So a notes payable, the word payable represents a liability, something that needs to be paid. So a notes payable is a loan that's payable. And of course, that's what liabilities are. These are debts that need to be repaid. When a company raises money, they will issue shares of ownership in exchange for cash from those new owners. And these ownership shares are what we call common stock. The word stock and shares is the same. Okay. And any amount that the company has earned from providing a service in this case, right? So if you went to the doctor or dentist and they did a checkup, or you went to a tax professional that did your taxes, that's an amount that's been earned by providing that service to you. That's what revenue is. Revenue is an amount that's earned by selling a good or providing a service. Okay. So this is what this part of the chapter talks about. That's what your whole work is going to be on for the next day. Any questions?